Hello, I'm Sebastian. Welcome to 9 Trees podcast. Today, I will summarize and review the book. Trend Following, 5th edition by Michael W. Covel, is a modern guide to one of the most enduring ideas in speculation, letting markets reveal direction, then riding that direction with rules and discipline. Rather than predicting tops, bottoms, or news outcomes, Covel focuses on a systematic approach that seeks to capture sustained moves across asset classes, including stocks, bonds, commodities, and currencies. The book is positioned for readers who want a framework that can function in bull markets, survive bear markets, and remain relevant during rare, violent dislocations often labeled black swans. Covel blends the philosophy of trend following with practical elements like risk control, position sizing, and the behavioral challenges that cause investors to abandon good processes at the worst possible times. The result is an accessible but serious overview of how professional managed futures and systematic traders think, and why rules can outperform opinions when uncertainty is high. I will give you key takeaways from this book. Firstly, a rules-based alternative to prediction. A central topic is the rejection of prediction as the primary tool for making money. Instead of forecasting economic data, earnings, or geopolitical events, trend following emphasizes observation and response. The market is treated as the final authority, and price action becomes the key input for decision-making. This orientation reframes trading as a process. Identify an objective signal, enter when a trend is confirmed, and exit when the trend ends, without requiring a story about why it happened. Covel presents trend following as robust because it can be applied across many markets and time periods, particularly when surprises make narratives unreliable. The value is not in always being right, but in structuring outcomes so that losses are kept small and occasional big moves pay for many small mistakes. This topic also highlights the psychological relief of not needing to guess, while acknowledging that rule-based trading still requires commitment during flat or choppy periods. The practical takeaway is a mindset shift. Your edge comes from consistency, not clairvoyance, and from building a repeatable method that can be tested, executed, and improved. Secondly, risk management as the core product. Trend following is often misunderstood as simply buying strength and selling weakness, but the more important engine is risk management. Covel emphasizes that survival is the first job because drawdowns and leverage can end a career long before a system has time to work. The book discusses how traders define risk per trade, cut losses, and avoid concentrating exposure in a single market or theme. The discipline to exit losing positions quickly is presented as non-negotiable since trends do not appear on demand and many signals fail. Position sizing, volatility awareness, and diversification across uncorrelated markets are treated as practical tools to keep losses manageable when the environment changes. This approach is especially relevant in black swan conditions, where correlations can jump and liquidity can vanish. The underlying logic is that you cannot control returns, but you can control the size of your mistakes. By making risk constraints explicit, a trend follower aims to stay in the game long enough to catch the rare but highly profitable extended move. The broader lesson applies beyond trading. Structured risk limits can protect decision-makers from emotions, overconfidence, and the temptation to double down. Thirdly, the mechanics of entries, exits, and trend capture. Another important topic is how a trend follower structures the trade lifecycle. Covel describes the general logic of using objective triggers to enter positions when a market demonstrates directional persistence. Instead of buying because something looks cheap or selling because it feels expensive, the approach waits for confirmation that price is moving and may continue moving. Exits receive equal attention because they are what transform paper gains into realized results and what prevent small losses from becoming large ones. Trend following commonly uses stop mechanisms to define when a position is wrong, along with trailing methods that allow profits to run while still protecting against reversals. Covel also addresses the reality that trend capture is lumpy. Many trades will be small losses or modest gains, while a minority of trades drive most of the performance. This makes patience and faithful execution essential, and it explains why a good system can look unimpressive over short horizons. The reader is encouraged to think in distributions rather than individual outcomes. The practical implication is to build a repeatable playbook, define what constitutes a trend, how you will enter, how you will size, how you will exit, and how you will handle periods when signals whipsaw. Fourthly, behavioral discipline and the cost of human instincts. Covel devotes significant attention to the behavioral obstacles that cause investors to abandon trend following right before it pays off. Human instincts push people toward buying what feels safe, holding losers to avoid regret, and taking quick profits to feel right. Trend following demands the opposite: accept being wrong often, cut losses without negotiation, and hold winners long enough to feel uncomfortable. This disconnect between instinct and method is presented as a major reason why the strategy can remain viable, because many participants cannot stick with it through drawdowns or boredom. The book frames discipline as a competitive advantage, not a personality trait, and suggests that rules, checklists, and predefined risk limits can substitute for willpower. Another behavioral theme is the seduction of stories. Markets generate endless explanations that make outcomes feel predictable in hindsight, but those narratives can encourage overtrading and late entries. By focusing on process metrics and long-term expectations, a trend follower aims to reduce emotional reactivity. The reader gains an honest view of what implementation really costs, discomfort, periods of underperformance, and social pressure when a systematic approach diverges from popular opinion. The payoff is a framework that can function when fear and greed dominate. Lastly, why trend following fits crisis and black swan environments. The book argues that trend following is particularly suited to environments where traditional models fail. In crises, diversification can break down, valuation anchors can become meaningless, and the urge to predict policy responses can lead to repeated errors. Trend following sidesteps many of these traps by reacting to price movement and by maintaining the flexibility to be long or short, depending on what markets are doing. Covel discusses the idea that large dislocations tend to produce sustained trends, as participants reposition, deleverage, or rush for safety. A rules-based strategy designed to cut losses and stay with winners can, in theory, participate in these extended moves, while limiting exposure when conditions reverse. This topic also clarifies that trend following is not a guarantee of profit in every crash, nor is it a perfect hedge. It is a way to build an adaptive portfolio process that does not depend on stable correlations or accurate forecasts. Readers are encouraged to view it as an all-weather mindset, prepare for fat-tail outcomes by controlling risk, diversifying across markets, and accepting that uncertainty is permanent. The practical result is a toolkit for navigating the unexpected without relying on fragile assumptions. In conclusion, this book is best suited for individual investors, traders, and finance professionals who are tired of prediction-driven strategies and want a clearer, rule-guided way to engage with markets. Readers who appreciate systems, statistics, and process discipline will get the most value. But the writing also helps curious beginners understand why simple principles like cut losses and let winners run are harder than they sound. The benefit to a reader's life is not only potential performance improvement, but also improved decision-making under uncertainty. Covel's emphasis on risk limits, diversification, and emotional control translates to better habits, less impulsive action, more respect for downside, and more patience with long-term plans. Compared with many trading books that promise secret indicators or rely on hindsight stories, this one stands out for framing trend following as a complete operating philosophy with practical implementation themes. It also places the approach in the context of bull markets, bear markets, and crisis regimes, showing why adaptability matters more than a single market outlook. For buyers comparing similar titles, the 5th edition is worth considering because it consolidates a mature, widely discussed approach into one coherent narrative focused on process, risk, and behavior rather than prediction. If you would like to support Michael W. Covel, you can buy the book through the Amazon link I've provided in the podcast description. After reading the book, please let me know what you think and share your thoughts. See you around.